Last year, a 34-year-old warehouse supervisor in Ohio quietly stopped showing up to work. Not because he got fired, not because he won the lottery. He simply chose to walk away. $1,100 had started arriving in his bank account every single month automatically. The money came from companies he had never set foot inside, for work he never actually did. His coworkers thought he was crazy when he started investing 5 years earlier. They laughed at him. Now those same coworkers are the ones asking him, "How exactly did you pull this off?" Here is the uncomfortable truth. The math behind what he did is brutally simple. Most people just never sit down and actually run the numbers. That is what we are doing today. Before we get to the numbers, let us make sure we're all working from the same definition. When a company earns a profit, it faces a choice about what to do with that money. It can reinvest that profit back into the business, buying equipment, hiring staff, expanding operations further. Or it can take a slice of those profits and distribute them directly to the people who own shares. Those distributions are called dividends. This is the foundation of everything we're talking about today. Think of it like owning a small piece of a restaurant franchise that makes money every single quarter. As a part owner, you receive a check reflecting your share of the profit automatically every quarter. You did not flip a single burger, you did not take a single order, but you still get paid. You get paid because you own a piece of the business. Ownership is what creates the income. That is dividend investing in its purest form, buying ownership stakes in profitable, dividend-paying companies, and those companies cut you a check on a regular basis, typically every 3 months. In some cases, these companies pay you every single month, 12 checks a year like clockwork. The percentage of your investment returned to you annually through these payments is called the dividend yield. This number is everything. It determines exactly how much capital you need to reach your income target. Here is the simple math that anchors this entire conversation. It starts with one clear annual target. If your goal is $1,000 a month in dividend income, you need $12,000 per year. That's your annual target. Everything in this formula flows from that single number you are chasing. The amount you need to invest depends entirely on one thing, the yield of your chosen investments. The formula is straightforward. Capital needed equals annual income target divided by dividend yield. That's it. At a 3% yield, you need approximately $400,000 invested to hit that target. At a 4 to 5% yield, you're looking at roughly $240,000 to $300,000. At a 6 to 8% yield, you could potentially get there with $150,000 to $200,000. At a 1.5% yield, the typical broad market index fund, the number jumps to around $800,000. See the range there? From $150,000 on the aggressive end all the way to $800,000. That's not a small difference. That gap determines whether this goal is even achievable within your lifetime. That's the difference between someone who achieves this in their 40s versus someone who never gets there at all. But here's the critical question. Why wouldn't everyone simply chase the highest yield and get there faster? Great question, and the answer might surprise you, because that logic, as tempting as it sounds, backfires badly. Imagine you're walking through a market and you see two fruit stands selling the exact same apples. One sells apples for $1 each, the other is practically giving them away at 10 cents an apple. Before you fill your bag with the cheap ones, you'd want to know, why are they so cheap? High dividend yields work exactly the same way. An unusually high number is not always a good sign. When a company offers an unusually high yield, say 10%, 12%, even 15%, ask why. In most cases, one of two things is happening inside that company. Neither one is particularly reassuring. First scenario, the company's stock price has fallen sharply, and that collapse is inflating the yield artificially. Yield is calculated by dividing the annual dividend payment by the current stock price of the company. So, a lower stock price automatically inflates the yield, even if the actual dividend payment hasn't changed at all. The dividend might be the same as a year ago, but the yield looks enormous because the company's value dropped. A dramatically inflated yield like this is often a signal of deeper problems happening inside the business. Second scenario, the company is paying out more in dividends than it can sustainably afford to keep paying. They're essentially borrowing against their own future just to keep investors happy and the numbers looking good today. And at some point, usually when the business hits any kind of turbulence, they cut the dividend. Sometimes by 30%, sometimes by 50%, sometimes they eliminate the dividend entirely, all at once. When that happens, the income you were counting on, the income you planned your life around, disappears overnight. This is exactly why experienced dividend investors tend to stay within a specific and deliberate comfort zone of yields. That comfort zone sits between roughly 2% and 5% yield, high enough to be truly meaningful, but not so high that it raises red flags about the financial health and stability of the company. Now let us talk strategy. There is no single right way to build dividend income. There are several distinct paths. Each path comes with its own trade-offs, different yields, different risks, and different timelines to your goal. Path 1. The reliable core. This means investing in blue-chip dividend stocks, large, established, battle-tested companies. These are businesses with decades of history that have survived recessions, market crashes, and major economic disruptions. And through all of it, they kept paying their shareholders every single quarter, without interruption, without excuses. These companies tend to offer yields around 2.5% to 3.5% annually. At 3% yield, you need that $400,000 figure we talked about earlier to hit your target. The trade-off is stability and predictability. These companies do not just pay dividends, many increase them every year. There is actually a specific group called dividend aristocrats, companies that have raised their dividend for at least 25 consecutive years. Think about what that means. Through the 2008 financial crisis, through the pandemic, through every downturn, these companies kept raising what they paid out to shareholders. That kind of track record is extraordinarily rare, and investors pay a premium for that consistency. Reliability in dividend investing has a very real price tag. Path 2. REITs, real estate without the headaches. This is real estate investing, completely reimagined for regular people. Real estate investment trusts are companies that own income-producing properties, office buildings, apartments, warehouses, data centers, hospitals. They collect rent from tenants, and by law, they are required to distribute at least 90% of their taxable income to shareholders. That legal requirement is exactly why REITs often offer some of the most attractive yields available in the market. REITs commonly offer yields in the 4% to 6% range, meaningfully higher than most blue-chip stocks. At 5% yield, you would need around $240,000 to hit your $1,000 monthly target. That's a meaningful step down from the $400,000 blue-chip benchmark, a significant difference. The catch? REITs are sensitive to interest rate movements. When rates rise sharply, REITs prices often fall. Real estate financing becomes more expensive when rates climb, and that pressure flows directly into REIT valuations. They're not as turbulent as individual stocks, but not as calm as broad index funds either, right in between. Path 3. Sector-focused investing. Certain industries historically pay higher dividends because their cash flow is consistent and predictable. Energy, utilities, and telecommunications companies generate reliable revenue streams, and they share a generous portion with investors. An energy company, for instance, might offer yields of 4% to 6% when commodity prices are favorable. The problem is concentration risk. When you load up on one sector, your income becomes tied to that industry's fortunes. Commodity prices, regulatory changes, geopolitical shifts, things entirely outside your control can cause dividends to evaporate quickly. Path 4. Dividend-focused index funds and ETFs. For many people, this is the most practical starting point available. Dividend ETFs pool together hundreds of dividend-paying companies into a single investment you can buy in one transaction. You get diversification automatically, professional rebalancing, and exposure to consistent dividend payers, all without analyzing individual companies. Yields on these funds typically fall between 2% and 4%, depending on the specific fund's focus. They won't make you rich overnight, but they provide a stable, scalable foundation for long-term income building. And that foundation is exactly what you need when you're building a dividend income stream meant to last decades. Here's where things get genuinely powerful and where most casual investors leave enormous money on the table. The concept is called dividend reinvestment, and it is, without question, the most underrated multiplier in personal finance. When you receive a dividend payment, you have two choices. You can spend it, or you can put it back to work. If you reinvest it, you buy more shares. Those shares generate their own dividends, and those buy even more shares. It sounds simple because it is simple, but the effect of doing this consistently over time is genuinely profound. Let's say you start with $50,000 invested in a dividend fund yielding 3% annually. In year one, you earn $1,500 in dividends. You reinvest every single cent of it. Now you have $51,500 working for you, not $50,000. The base has grown. Next year, your dividends are calculated on that larger base. The year after that, the base is still larger. After a decade of doing this and adding even modest monthly contributions on top, the growth becomes hard to ignore. The mathematics are, as one investor famously put it, ruthlessly in your favor. Time does the heavy lifting for you. This is also where time becomes your most valuable asset. Not your salary, not your connections, just time. Every single year you delay reinvesting is a year you're actively robbing your future self of compounded returns. Nobody loves talking about taxes, but skipping this part is exactly how people end up deeply disappointed later. Dividends held in a regular taxable brokerage account are typically considered taxable income by the government. Qualified dividends receive preferential tax treatment. They are taxed at capital gains rates, not ordinary income rates. But you still owe something to the government. Preferential treatment does not mean free, it just means less. Here is what this means practically. If your goal is $1,000 per month in net income after taxes, you may actually need to generate closer to $1,200 to $1,400 per month in gross dividends. How much exactly depends on your bracket. The higher your income, the larger the gap between gross and net. The cleaner solution is to hold dividend investments inside tax-advantaged accounts and let them compound without annual tax drag. The most common options are a Roth IRA, a traditional IRA, or a 401k retirement account. Inside these accounts, dividends can compound year after year without any portion being taken out for annual taxes. The trade-off is real. These accounts carry contribution limits and strict withdrawal restrictions that require careful long-term planning. This matters especially if your goal is financial independence well before the traditional retirement age. Planning ahead is everything. So let us step back and look at the full picture of everything we have covered today. To earn $1,000 every month in dividends, you need somewhere between $150,000 and $800,000 invested. That number depends on your strategy, your risk tolerance, and how much time you are willing to let your money grow. That range might still feel overwhelming, but here's the reframe I want to leave you with before you go. Most people spend their entire working lives trading time for money. Every dollar earned requires an hour of their attention. Dividend investing is the slow, disciplined process of building a system that completely reverses that equation, a system where money works on your behalf and your time gradually becomes yours again to spend freely. You do not need to start with $400,000. You need to start with whatever you have right now. Even $100 invested in a quality dividend fund today is one brick in a wall you are building. The wall doesn't look impressive after one brick. It rarely does, but that brick still matters. It counts. 20 years of consistent, patient bricklaying changes everything. That's how ordinary people build extraordinary financial outcomes. That's how people wake up one Tuesday morning, check their phone, and find money sitting in their account. $1,000 already there, already deposited before they've even had their first cup of coffee. The people who get there don't have a secret formula. They don't have special access or insider advantages. They just started. And then, more importantly than anything else, they simply did not stop. That's the entire secret.